If you still have, or know someone who has, hope to see an economic upturn this year, we're sorry to crush your expectations. But this winter is likely to be the worst ever recorded in American history. We know that many of our subscribers are totally aware it won't be easy nor simple to get out of the economic rock bottom America has gotten into. But somehow, the mainstream media outlets have managed to keep maneuvering information to make the massive storm of layoffs and bankruptcies look less terrifying, always asserting that we're now in a process of economic recovery, even though way before the crisis, boosted by the sanitary outbreak, had started, the U.S. economy was already on its way to a downfall. And so far, the best we have witnessed was a pause on the deterioration process. Wall Street may be experiencing historic highs, but this can't be used as a point of reference for what's happening in the real economy. Those highs say nothing about the millions of American households that have been in a loop of financial pain since the health crisis started, while a handful of billionaires is only getting wealthier at the expense of a decaying system. It's in that sense that today we gathered a compilation of recent events that are likely to reverberate in a catastrophic manner during the coming winter, pushing any idea of a recovery out of the picture. So keep with us. Don't forget to like this video, share it with your friends, and subscribe to our channel to keep updated with the future videos. The past 6 months, we dare to say 9 months, have been painful on so many different levels. The current crisis has made many Americans lose their loved ones, their jobs, homes, cars, and prospects for the future. Even before the viral outbreak had started, businesses were filing for bankruptcy, but the unemployment rates that resulted from the present collapse were unexpectedly high, especially after witnessing the historic low in February. The first spike was shocking, with over 1 million jobless claims registered in a week, and although the numbers haven't peaked that high in recent days, last week another 800,000 claims were filed, and forecasts for the winter indicate that tens of thousands of workers will be permanently laid off by the end of the year, according to a recent piece published by the WST. We're on a path to set new records for retail store closings, retail bankruptcies, and retail liquidations this year. The publishing states that retail store closings in the U.S. reached a record in the first half of 2020, and the year is on pace for record bankruptcies and liquidations as the sanitary crisis accelerates industry changes, particularly the shift to online shopping, according to a report on the downturn severity. Also, it was reported on the news that in the first half of 2020, 29 retailers have filed for bankruptcy as the health crisis restrictions aggravated the already bleak outlook for brick-and-mortar stores due to a shift in consumer spending to online shopping. The article reveals that from January to June, 18 retailers, including once popular brand names like Neiman Marcus, JCPenney, Pier 11, and GNC, filed for Chapter 11, according to the financial advisory firm BDO USA. And during the 6-week period, started at the beginning of July until mid-August, 11 more retailers have filed for bankruptcy. Apparel retailers have been affected the most by this trend, and it is extremely unfortunate to see some of the most iconic brands in the entire industry hitting the end of the line. According to the report, among the notable companies that went belly up over the last summer are Lord & Taylor and its subsidiary, La Tote, Tailored Brands, which is the parent company of Men's Warehouse, Jose Bank, and Ann Taylor's corporate parent, Ascena Retail Group. The article also warns that if the current trends continue, the 2020 retail bankruptcies will exceed the ones that happened in 2010, when 48 retailers went bankrupt during the Great Recession of 2007 to 2009. This tendency has been going on for a while now. In 2019, 22 retailers filed for bankruptcy, summing to a total of 5,998 store closures up until this point. And every week, more and more companies announce they will be shutting their doors for good. Last week, coffee giant Starbucks disclosed that 400 of its restaurants would close, while telecom behemoth AT&T will have 250 of its locations shut down. Bed Bath & Beyond will downsize 200 of its outlets, and Macy's will be closing 125 of its stores. The increasing reliance on online shopping and the strict lockdown and social distancing measures have intensified the struggle many of these businesses have been facing in order to stay afloat, and enhanced even more the downward trend. At the beginning of this month, the government registered data that showed that despite Americans were spending more on retail, the pace wasn't high enough to prop the economy up. The U.S. Commerce Department documented a 0.6% rise in retail sales in August, lower than the 0.9% increase in July. It's also below the 1.1% increase analysts expected. Ian Shepherdson, chief economist at Pantheon Macroeconomics, said that these are disappointing numbers, and they're probably a hint of what's to come in the wake of the ending of enhanced unemployment benefits. Roughly 30 million laid-off workers stopped receiving the $600 federal unemployment check by the end of July. The sum helped to support consumer spending, which represents 2/3 of all economic activity, and it has been closely monitored by economists assessing America's economic health. However, the retail sales report only covers 1/3 of the overall consumer spending, and other businesses such as hair salons, cinemas, and hotels aren't included in the report, regardless of having been completely smashed in the current collapse. In any case, the retail sector isn't the only one that has been absolutely hammered in the face of this unprecedented economic meltdown. While Congress and the Trump administration have been squabbling over a new stimulus bill, Wall Street has started panic buying stocks, expecting a positive outcome over the current discussions to issue another round of economic stimulus. And the broader commercial real estate market, by contrast, continues to implode at the epicenter of New York City, where nearly 6,000 business closures have resulted in a 40% eruption in bankruptcy filings across business districts of all 5 boroughs this year, reported Bloomberg. Yesterday, Zero Hedge featured the statement of Al Tagut, a bankruptcy lawyer that has been handling insolvencies from small firms to mega corporations, who affirmed by late fall there will be an avalanche of bankruptcies. When the cold weather comes, that's when we'll start to see a surge in bankruptcies in New York City. On the other hand, Scott Stringer, New York City Comptroller. On the other hand, Scott Stringer, NYC Comptroller, who will also be a candidate in next year's mayoral election, said this situation is a crisis and we need to act because our economy can't recover without saving small businesses. When they close, we don't just lose our beloved Main Street businesses, we lose jobs, tax revenue, and the economic backbone of our city. Moreover, the Partnership for New York City, a nonprofit membership organization of New York City's top businesses, alerted that the effects of the health crisis-related restrictions could potentially close 1/3 of the 230,000 businesses across all 5 boroughs for good. The Bloomberg report also described that bankruptcy filings in the region have soared since mid-March, which was when the state of New York reported its first casualty from the viral outbreak, leading Governor Andrew Cuomo to close all non-essential businesses. Court records show that there were 610 filings in the southern and eastern districts of New York from March 16 to September 27, marking a 40% surge from the same period in 2019 and the highest by far for any year since the financial crisis. The districts include some nearby counties, according to the Bloomberg report. Also, Yelp data pointed out that almost 6,000 New York City businesses closed from March 1st to September 11. From those, more than 4,000 have closed permanently. All of these events were a hard coup for morale, since the city has been fighting back for decades the threats of bankruptcy, the scourges of illegal drug usage, vicious crime, turbulent attacks, and recession. The sanitary outbreak hit as the city had achieved record high employment and low crime, outlined Bloomberg. Additionally, New York City restaurants joined up to sue the state for $2 billion in damages, proclaiming that the government is violating the constitutional rights of the owners of more than 150,000 New York City restaurants. And experts considered the move very worrying, since the spread of closures is already pressuring the commercial real estate market in the city. With such an economic scenario, it seems odd to see that the media outlets are still talking about a recovery, as more businesses shut down or workers will be laid off. And this year, we have already witnessed more than 60 million American workers file new claims for unemployment benefits. And it looks like we will see another wave of unemployment crashing by December. We just learned that KPMG will be wiping out 1,400 jobs, and these are well-paying jobs that won't be easy to replace. For its part, Disney communicated that it will eliminate 20 times as many jobs, being set to lay off around 28,000 employees in the United States, as prolonged closures and limited attendance have decimated its theme park business. The announcement was made in a letter to employees Tuesday from Josh D'Amaro, Disney's head of parks, who detailed several difficult decisions the company has been forced to make amid the ongoing health outbreak, the Daily Mail revealed. Considering the countless billions of dollars the theme park company made over the past several decades, it seems really harsh to let so many workers go, knowing they are definitely not in danger of going bankrupt. It's safe to say that even if the company continued to pay its workers throughout these tough months, it would still remain far from the edge of collapse. And on top of all these overwhelming announcements, here comes even more concerning news. The airline industry is on the brink of a historical fallout if the federal government doesn't proceed to enact a massive bailout. According to Wolf Richter on his daily Wolf Street Economic Examination, October 1st is the day U.S. airlines that accepted their portion of the $25 billion bailout under the CARES Act can start involuntary layoffs of their employees. They've been shedding large numbers of employees since March, but through voluntary buyouts, early retirements, and other programs that induced employees to temporarily or permanently leave. Now, the airlines are engaged in a desperate lobbying effort to get legislation signed into law that would provide the next $25 billion bailout package. Threats have been flying, so to speak, to motivate Congress to get this done. American Airlines CEO Doug Parker told CBS News on Sunday that if there isn't a new bailout program, there are going to be 100,000 aviation professionals who are out of work who wouldn't be otherwise. This would include the 18,000 employees American Airlines has threatened to lay off. All these crushing events are going to resonate on winter's unfoldings, and soon we will unfortunately see more people in financial distress and more businesses disintegrating. From where we stand, the economic future doesn't look any more promising. The dominoes are falling, and and our society is crumbling. We do hope America still has the resilience to deal with everything that is coming for us.